It looks like sales fell into the gap at Gap stores and other retailers last month. December chain store sales were disappointing even after department stores and discounters slashed prices to move merchandise. The big winners in the race for receipts were higher-end sellers.
Call her Madam Speaker. Nancy Pelosi made history today. Elected as the first female Speaker of the House, she took her new post as the democratically controlled 110th Congress formally took office.
It will be this man's job to sell the president's new budget to that Democratic Congress. We talked with Treasury Secretary Henry Paulson about working with the Democrats, reining in CEO pay, and the boom in private equity funds.
Business at Boeing is taking off. The aircraft maker logged its best year ever for new plane orders in 2006. Selling like a dream, Boeing's new 787 Dreamliner model.
I'm Paul Kangas.
And I'm Suzanne Pratt. Susie Garib is off tonight. This is Nightly Business Report for Thursday, January 4th.
Nightly Business Report is made possible by
Franklin Templeton Investments, providing a unique perspective through the specialized investment expertise of Franklin Templeton Mutual Series and Fiduciary Trust. Franklin Templeton Investments. Gain from our perspective.
And by A.G. Edwards.
This program was made possible by contributions to your PBS station from viewers like you. Thank you.
Good evening, everyone. Not much cheer today from the nation's retailers. Sales at many of the biggest chain stores were disappointing in December. Even a big rush of last-minute shoppers wasn't enough to save the holiday season. Erica Miller has more on what kept Americans out of the stores.
The holiday shopping season turned out to be pretty dismal for many of the nation's chain stores. Many merchants reported weak December same-store sales results. According to Thomson Financial, the majority of chain stores missed Wall Street sales projections. Disappointments crossed all categories, from limited brands to Ann Taylor to Hot Topic. Bear Stearns analyst Christine Augustine says unseasonably warm temperatures were partly to blame.
We think the unusually warm weather in December did hurt sales of things like coats, hats, scarves, mittens, boots, because the consumer tends to shop on an as-needed basis, unless we're talking about a really high-income consumer who will buy, for fashion or ahead of the season.
That helps explain why luxury retailers generally fared well. Nordstrom was a major standout, with sales results up 9% during the month. Analyst Richard Jaffe of Stifel Nicolaus also credits the right merchandise mix.
Clearly, Nordstrom has done tremendously well offering premium brands and improving their women's offerings. They were able to catch the accessories fad. Sunglasses in the winter, very popular and very much a fashion accessory.
At the other extreme was the Gap, where sales tumbled 8%. Even heavy discounting couldn't entice shoppers to load up on merchandise there. Walmart, the world's largest retailer, reported a 1.6% gain, higher than expected, thanks to strong demand for electronics. Sales results at many stores were hurt by two major shifts in the way consumers are shopping. The first is the increasing popularity of gift cards, which account for roughly 20% of all holiday sales. Those sales don't officially count until the cards are actually used.
We would expect anywhere from 50 to 70% of those gift cards to actually get redeemed by the end of January. So January is becoming a more important month than it was historically. It's not the throwaway month that it used to be.
Another change is the growing trend toward online shopping. Although many stores include internet purchases in their same-store sales figures, some do not.
It will be well into February until we have a good sense of how much profits were hurt by seasonal markdowns. Already a number of merchants, including Gap and Ann Taylor, have cut their profit outlooks. Erica Miller, Nightly Business Report, New York.
Oil prices hit the skids in trading in New York again today. Light sweet crude for February delivery plunged $2.73 to $55.59 a barrel. That's a drop of almost 5% after falling 4.5% yesterday. The move was due to unusually mild weather in the Northeast and a big buildup of inventory. New government figures out today show gasoline stocks rose by more than 5.5 million barrels, with distillate inventories rising by 2 million barrels. But the developments are not sitting well with OPEC. The cartel says it will consider holding an emergency meeting if oil prices continue to fall. Also falling early today were stocks on the prospect of OPEC cutting production and, of course, those mixed retail sales which raised concerns about consumer spending. An hour into trading, the Dow was off 53 points, NASDAQ down 4. Despite the weakness, Intel led an impressive rally in the tech stocks, which helped the blue chips eventually end on a positive note. The Dow Industrial Average closed up 6.17 at 12,480.69. The NASDAQ Composite vaulted 30.27 points to 2453.43, and the Standard & Poor's 500 up 1.74 at 1418.34. Over in the bond market, the 10-year note rose 14 seconds to par and 4 seconds, putting the yield at 4.61%.
With much ceremony and enthusiasm, Democrats today officially took the reins on Capitol Hill. Not only are Democrats in charge for the first time in 12 years, but they are led by the first female Speaker of the House. The Democrats are eager to push their agenda and have promised to accomplish it in the first 100 hours of the session. Stephanie Dew reports.
In the House, Nancy Pelosi accepted the Speaker's post with a promise of bipartisanship and a new agenda for the future.
I accept this gavel in the spirit of partnership, not partisanship.
In the Senate, Harry Reid made a similar pledge as the newly elected majority leader.
The voters want a government that focuses on their needs. The voters want change. Together, Democrats and Republicans must deliver that change.
House Democrats promise votes on a slew of campaign promises over the next 2 weeks or 100 legislative hours. Of special interest to business are Democrats' plans to increase the minimum wage, give the federal government the authority to negotiate drug prices for Medicare, and a repeal of oil company tax breaks. U.S. Chamber of Commerce President Tom Donahue says businesses are focused on what happens in the Senate after the initial legislative push in the House.
While the Congress is talking about controlling spending, what they want to do in the first 100 hours is give a lot of things away and pay for it by taking a lot of things away. And we understand that. It's all part of the electoral process, but then it's going to have to get through the Senate, it's going to have to get through conference, a lot of these things are going to change.
Democrats and the business community may find common ground on the issue of immigration, but analysts say businesses will mostly be playing defense. Lehman Brothers analyst Chuck Marr says that could bring risk for investors in pharmaceuticals, student lenders, and oil companies.
What you're going to see are waves of sectoral risk. And you'll see risk in a particular sector. There'll be nervousness in advance of a proposal, see how far it goes, and then the risk will either, the wave will either subside or people will get wet.
Analysts say the window for Democrats to pass their legislative agenda will close quickly. By the summer, next year's presidential election race will likely overtake the spirit of bipartisanship promised today. Stephanie Dew, Nightly Business Report, Washington.
As the Democrats take control of the House, Treasury Secretary Henry Paulson is hoping members of Congress will embrace President Bush's soon-to-be-released new budget. That plan is expected to call for extending tax cuts and increasing defense spending while holding the line on other programs. In an exclusive interview, Washington Bureau Chief Darren Gersh talked with Paulson this afternoon and began by asking how he plans to sell that budget to the Democrats.
I think it's going to be an easy budget to sell to the American people and hopefully to sell to members of the Congress, because it shows real progress with regard to the deficit. You know, we're 3 years ahead of schedule to cut the deficit in half, and the budget shows steady progress in balancing in 2012. And the key is a strong and growing economy and tax revenues that are coming in at a very fast pace.
Now, the president has, for years, said his goal was to cut the budget deficit in half. And the administration has argued that the budget deficit at current levels was really not much of a factor in the economy. So why is it that the president was okay with the budget deficit when Republicans were in control, But now Democrats are in charge, and he wants to balance the budget.
This is a natural extension of where we've been going, and nothing has changed in terms of the fiscal situation in the last 4 or 5 months. It's a strong fiscal situation. We've got a budget deficit that's less than 2% of GDP, and and given the fact that revenues are coming in and the economy is strong, it looks like we're going to be able to balance.
You came to Washington in large part, because you wanted to work on entitlement reform. And lately I've been hearing Democrats and Republicans talk about back in the mid-'80s when Ronald Reagan, Tip O'Neill, the Democratic speaker, got together and they shored up Social Security. Would the administration accept a deal on Social Security that shored it up financially, that ensured solvency, but didn't reform the system, didn't add the private accounts the president wants?
Well, let me be real clear here. As we've talked, and as I've talked to members of Congress, there is a real understanding on both sides of the aisle, Democrats and Republicans, that this is a serious problem, and there's a real understanding that it can be fixed, but it's going to be very difficult because the impediments are political. And so no one says it's going to be easy. And so we're at the stage right now where I'm not dealing in hypotheticals. What I'm doing is I'm reaching out and I'm getting some receptivity and saying, let's come in and let's discuss this topic and let's not have any preconditions. You know how strongly that we feel about personal accounts. We're not going to take those off the table. We're not going to ask you to take things off the table that you may want to put on the table. So everybody will come in with their ideas and we will talk.
Let me ask you about CEO compensation. I understand that the Senate Finance Committee is looking at the tax treatment of these huge stock option grants that fired CEOs like Bob Nardelli at Home Depot are getting. Do you think it's a good idea to take a look at the tax treatment that stock options get, and might that have an impact on executive compensation?
Well, I'm very willing to talk with either the Senate Finance Committee or the House Ways and Means about tax treatments and tax generally. I don't believe, radical or dramatic tax reform is the answer to CEO compensation.
Do you think the tax treatment of stock options, because they're tax favored, has encouraged pay?
We could have quite a discussion about whether it's tax favored or not, because that CEOs don't pay taxes on stock options until they're realized, okay? And many stock options expire worthless. They're only worth something if the stock price goes up. But again, I don't believe the issue of CEO compensation and any excesses there, I don't think that's it's a tax matter. I think that's another matter, and that's between shareholders, boards of directors, and the CEOs.
You also chair the President's Working Group on Financial Markets. Right. And there's a lot of money flowing into private equity right now. And I hear some concerns that there's a lot of debt being built up because of the private equity boom. And some people are worried that when you have a lot of debt, things could end badly. Is that an issue that you're looking at?
I would say that the President's Working Group is looking at a number of topics, and we're very carefully following changes in the capital markets. And one of the changes in the last 4 or 5 years has been a pretty dramatic increase in private pools of capital. And these would be private equity funds, hedge funds, and I believe by and large that private pools of capital have made our capital markets more efficient, more effective. They've been good for the capital markets, but there have been significant changes, and I think it bears looking at pretty carefully, and so we're taking a careful look at it.
Secretary Paulson, thank you for your time.
Thank you.
The Federal Trade Commission today imposed fat fines on the marketers of 4 weight loss pills, saying the companies padded their advertising claims. The products will remain on the shelves, but the marketers will have to stop claiming they ensured rapid weight loss and cut risks of osteoporosis, Alzheimer's, and even cancer. Marketers of One-A-Day Weight Smart, Cortislim, Trim Spa, and Zenadrin EFX will pay a total of $25 million in fines. Some of that money will go to consumers who say they were deceived by the misleading advertising. Meanwhile, drug maker Eli Lilly has agreed to settle most of the lawsuits now pending against it over its drug Zyprexa. Thousands of patients claim the drug caused them to develop diabetes. Zyprexa is prescribed as an antipsychotic treatment. It is Lilly's single biggest product, generating annual sales of more than $4 billion. But those sales have been declining over concerns of weight gain, often a factor in developing diabetes. Lilly will take a charge of up to $500 million in the fourth quarter to cover the settlement. But the Zyprexa controversy will continue, Paul. There are still more than 1,000 claims not covered by this deal, and they are expected to go to trial.
Well, the news barely budged the stock, Suzanne, although Lilly's share did gain 11 cents to close at $52.36. Now let's look at the rest of our stocks in the news tonight. Big board volume leader on 20.7 million shares, Ford Motor moving up 19 cents, followed by ExxonMobil, representing a very weak energy group, down $1.39, traded as low as $72.21 today. AT&T off 45 cents, GE down 22 cents. ConocoPhillips, another weak oil stock, also into natural gas big time, down $2.12. Pfizer managed to gain 9 cents, and EMC a 33-cent advance. Time Warner rose 39 cents. Halliburton Oil Service got hit today, too, down 64 cents. 10th in volume, Corning with a gain of 69 cents. More weakness in the oil-related stocks. These are the oil service sector. BJ Services, Ensco, and Weatherford International all on the downside, especially after Wachovia downgraded all three of these from outperform to just market perform. Monsanto lost 89 cents, although it did trade as high as $51.21 this morning after reporting first quarter earnings of 16 cents up from 11 last year and 6 cents above the street estimate. But the company did not boost full year earnings estimates, remain at $1.57 at best, and the street estimate is for $1.61, so a little disappointment there. Texas Industries up $2.03. The building materials company had a sharp jump in second quarter earnings to $1.09, up from 26 cents last year, and the street estimate was only 55 cents. But keep in mind, 47 cents of that $1.09 in earnings was due to a non-recurring item, tax-related. Constellation Brands, the wine and spirits distributor, third quarter earnings excluding items, 58 cents, up from 52 last year, but 2 cents below the street estimate, and the company cut its fiscal 2007 earnings estimate from $1.76 at best down to $1.70 at best. The Limited Brands, one of the apparel retailers, down $2.23. The December same-store sales were up a lower than expected 4%. The company itself forecast a high single-digit rise in sales, didn't make it. New York & Company, another apparel retailer, up $2.07. Its December same-store sales up 3.2%, and most of the street was expecting a small decline, so better than expected. Aeropostale, another apparel retailer, up $2.21. December same-store sales up 1.7%, and the company boosted its fourth quarter earnings estimate by about 2 cents. Then Cooper Companies, which makes contact lenses, up $1.82. There's a continuing takeover speculation, but no suitors as yet named. And then RPM International, original name was Republic Powdered Metals, so we know what business they're in. Second quarter earnings tripled to 45 cents versus 15 a year ago, 9 cents better than the street consensus. Google topped the active list on NASDAQ, up $15.67. The company bought a stake in a Chinese file savings firm. And then Apple Computer up $1.86. Research in Motion did well, up just over $10. Cisco Systems, 73-cent gain there. This company is buying Ironport Systems for $830 million. Ironport is a privately based web security provider. Intel, 82-cent gain there. Intel got a boost from Bank of America, which repeated a buy and boosted fourth quarter earnings. Microsoft, a nickel drop, and then Amgen up $2.39. Bear Stearns upgraded Amgen to outperform. Then we see Qualcomm up $1.69, Yahoo up $1.24, and Dell rose 75 cents a share. Elsewhere, Hot Topic down $2.31. The novelty retailer had a 5.1% drop in its December same-store sales. Those are the stocks in the news tonight. Suzanne?
2006 was a big year for Boeing. The jet maker logged its best year ever for new orders with commitments for more than 1,000 new planes. Much of that success is credited to the popularity of its lightweight, wide-body 787 Dreamliner with Asian and Middle Eastern airlines. Boeing's orders in 2006 will likely top that of European rival Airbus. Airbus had just 687 new orders at the end of November. But Boeing lagged Airbus in deliveries. Boeing's stock jumped 26% last year as the company worked to put its Air Force procurement and management scandals to rest. Today, Boeing shares rose 36 cents to $89.53.
Tomorrow, our Friday Market Monitor guest is Michael O'Higgins, president of O'Higgins Asset Management.
Here's a look at what's happening tomorrow. The markets will be focused on the December employment report, and Federal Reserve Chairman Ben Bernanke speaks in Chicago on bank supervision. Tonight's commentator has been looking at how stock options are granted to America's corporate leaders, and he doesn't like what he sees. Here's Tom Stewart, editor of the Harvard Business Review.
The other day, the Wall Street Journal published a list of the 25 CEOs who made the most money from stock option grants from 1992 to 2005. There were some staggering sums and many names familiar to people who track grandiose CEO compensation. But a few names shocked me. The original well-intentioned idea behind stock options was to give professional managers some skin in the game so they'd think like owners, not hired hands. Well, if that's the purpose, why do 7 names on the Journal's list belong to people who are already mega owners because they founded the company? Why did Larry Ellison, who owns 24% of Oracle, get options to buy 6 million more shares last year? Richard Fairbank, founder of Capital One Financial, last year 26% of all Capital One's options went to him. Howard Schultz owns 32 million shares of Starbucks, but last year got options for 1 million more. One person on the list, computer maker Michael Dell, seems to have learned that there's something unseemly about giving stock options to a company's founder. His pay package no longer contains the fat grants it once did. As for the others, how much stock do you need before you start thinking like an owner? Doesn't 40 million shares of stock, as Irwin Jacobs of Qualcomm owns, give him enough incentive to get the price up? Does he really need options for 500,000 more? Wishing us all a prosperous new year, I'm Tom Stewart.
That's Nightly Business Report for Thursday, January 4th. I'm Suzanne Pratt. Good night, everyone, and good night to you, Paul.
Good night, Suzanne. I'm Paul Kangas, wishing all of you the best of goodbyes.
Nightly Business Report is made possible by
Is your nest egg in shape for retirement? Objective financial advice can help. A.G. Edwards, for more than 118 years, fully invested in our clients.
Franklin Templeton Investments. After 50 years of worldwide investing, we see market opportunities through the eyes of experience. Franklin Templeton Investments. Gain from our perspective.
This program was made possible by contributions to your PBS station from viewers like you. Thank you.